And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the show. My name is Al Gordon, and as always, I'm working on your financial freedom. And over the weekend, I was hanging out with a bunch of Lifestyles Unlimited members, and we were visiting a property that is currently owned by a Lifestyles Unlimited member. And what that member was allowing us to do was walk through a property that he was in the process of remodeling. In other words, there were a lot of things wrong with this particular property when he bought it. I want to say there were about 60 different Lifestyles Unlimited members at the property, and the property isn't very big. But I'll tell you what happened. Learning. We had the benefit of a Lifestyles Unlimited single-family mentor, Joey Sullivan. He was hanging out with us, and he was kind of walking us through the entire process. So let me tell you a little bit about this property, and I'm going to take you back to 1940, because in 1940, this property was built. It's about 700 square feet, and when it was purchased by the Lifestyles Unlimited member, it was in pretty rough shape. The member bought it in the year 2023, towards the fourth quarter of the year. So imagine a house that was built in 1940, has 1940 style construction. In 1970, it was remodeled. And then since 1970, nothing really happened to the property. Nothing nice occurred to the property. It was in bad shape. The member told me that the property smelled like the smell of money. Now, what's the smell of money? The smell of money to a real estate investor is the smell of maybe cat feces, or, yeah, I said it. I'm serious. Cat feces, or trash, litter scattered around the house, broken windows. Yeah, broken windows don't smell, but what they do is they let the outside air in, and they allow whatever critters got into the house. Yeah, see, you know where I'm going, right? So this particular property sat vacant for a little while. A window got broken, animals got into the property, and the animals did in the property what animals do in the property when the property is vacant and there's nobody there to shoo them out. They kind of occupied the property, and they did their business in the property. And when the member bought the property, he walked into the property, and the first thing that hit him was the smell of money. And he knew right away that this was a property that was going to make him a ton of money. Now, why did he know that? I mean, let's take a step back and let's try and unpeel this onion. Yeah, onions kind of smell, right? Yeah, just sorry, my attempted humor on a Wednesday. Anyway, the point I'm trying to make is that when he walked into the property, he realized that he was going to make good money on this property. And later on in the show, I'll get into the money that he's actually going to make on this property, because this is a home run property. Now, this particular property was nasty. Bad repair. No repair at all to speak of. It smelled like you know what, and it was the smell of money. And ironically, nobody wanted to buy this property. Nobody could see past the current condition of the property until a Lifestyles Unlimited member went to the property. Now, a Lifestyles Unlimited member is trained to see past what the current condition of a property is and to take a look at what the property can do. Now, before this member even went to the property, this member did something called a financial analysis. In other words, when you become a member of Lifestyles Unlimited, one of the first things we're going to teach you is don't drive around looking at properties. It's a big waste of your time. It's a big time suck is what it is, and it won't get you the results you're looking for. What you need to do is you need to do a financial analysis of the property before you even go to look at it. This member did a financial analysis of this property. And the neat thing about this analysis was that the member determined that this property, if he had held it for a period of 5 years, would return. Now, are you sitting down? Because you need to be sitting down for this number. This property would return approximately 545% return on investment over a 5-year period when you consider the 5 different ways we make money in real estate. And those ways are the cash flow, the equity capture, the natural appreciation, the tax benefits, and the principal pay down. All of these factors contribute to you making great money in a property. And the other thing that caught this investor's eye was the amount of cash that he would need to put out of his pocket and into this property. Now, are you still sitting down? Because here's the number, $11,500. Let me just tell you what I see. I can already tell just by looking from the pictures that the roof's in bad shape. I'm guessing the foundation's in bad shape. There's no skirting around the property, so anything can crawl underneath the property. Now, get this. Where one of the piers ought to be holding this property up, there's a plastic bucket. You heard me correctly, a plastic bucket. Yeah, I'm looking at it. It's right there in the picture. It almost is. Well, I was going to say it's the name brand of one of those big box stores where you go buy your home building supplies. You can fill in the color you want, but that's what I'm telling you is holding this property up. So this thing is in bad shape. So, what's actually wrong with this property? What needed to be remediated on this property? Well, let me just go through the laundry list of things that he had to do to fix this thing up. He needed to put new posts and new beams under the property because he had to level the foundation. The foundation was like a roller coaster. When he told me that he walked through the property the first time, it was like walking along a roller coaster. The floor was not level at all. The floor is completely level now. The roof, like I said from the picture, is in bad shape. He qualified that statement. He had to put a new roof on. He had to demo the old shingles and install new shingles on the roof. He had to install new electrical and a ductless mini-split air conditioning system. He basically put 2 of them in the property because it didn't have air conditioning prior to this time period. Because remember, this thing was built in the 1940s, way before we had something called air conditioning. He had to paint the entire exterior. He had to demo the entire bathroom and install new basic tub, subway tile, a vanity mirror, a toilet, a sink, a faucet, and a bathroom door. Because there was no bathroom door on the thing. Now, imagine that. There was no Now, I know the animals that got in there didn't steal the door, so maybe somebody else got in there and took the door away. I don't know. I wasn't there. I'm just giving you an idea of what the property looked like. The kitchen, nasty, ugly. It had to be completely demoed. He installed a brand new stainless steel sink. He replaced the old cabinets with new shaker cabinets and replaced the countertops with new granite countertops. I mean, they look great, trust me. He installed new basic knobs and handles in a matte black finish, and he opened the wall in front of the kitchen in the sheetrock because the property was kind of boxy. So what he did was he made it an open and airy interior. It really flows nice, and there are people out there that are looking for this type of property. Now, the bedroom, the property started with 1 bedroom. He realized that he could increase his market rent potential if he could convert that 1 bedroom into 2 bedrooms. So you know what he did? He converted it into 2 bedrooms. So now you've got a nice little master bedroom area, and then you've got a second bedroom, which is great for children. It's the perfect size for children. And the neat thing about those rooms is they have like 10-foot ceilings. Yeah, so they're really open and airy, and they're voluminous. They're really voluminous. Now, the flooring that was in the property, it all had to go. So he put brand new vinyl plank flooring in and new baseboards throughout the entire property. Lighting was atrocious. He had to gut the existing lighting. He put in new recessed lighting in the kitchen, in the living room, in the bedrooms. He actually put, now get this, I thought this was a neat feature. I hadn't seen this in any of the other properties that I've walked recently, but he put motion sensor lights in the closets so that when you went into the closets, the light automatically came on. You didn't need to have a switch plate on the wall. I thought it was a pretty neat little feature. He put new lighting in the hallway, new lighting in, well, anywhere that needed lighting, he put lighting in. And I'll tell you what, when you compare that to the color choices that he made on the property just pops. It looks like a modern 2024 type of property, even though it was built in the 1940s. He put new doorknobs throughout the entire property. And the final touches, man, he pulled out all the stops because he brought the property up to code. What does that mean, he brought the property up to code? Well, it means he put in the proper carbon monoxide detector. He put in the proper fire alarm systems. You know those smoke detectors? Yeah, he put those things in. He put a peephole in the doorknob. He put in keyless door locks on the front and the back door. Now, why did he do those things? Because the code where the property exists, which is in the greater San Antonio market, requires that you have a peephole on all entry doors so that people can look out and see if there's somebody on the other side of the door. And you put keyless door locks on so that in case there's an emergency and you have to get out, you don't have to fumble around and look for a key. You just have the ability to flip the knob, so to speak, and get out of the property. The final thing that he had to do, he had to haul away a bunch of trash. I'm talking a bunch of trash. Now you're probably thinking, wow, Al, this is sounding a little bit expensive. What did it cost him to do all that stuff? Well, my analysis, and I compared it to his invoices, turned out to be about almost $53,000. It cost him almost $53,000 to do that. And some of you are saying, well, wait a minute, Al. At the beginning of the show, you mentioned that it only cost him $11,500 cash out of pocket to do this deal. How the heck could he afford to pay almost $53,000 in renovation costs on this property if he only put $11,500 into the property? Well, see, there's where the rubber meets the road. See, because he's a Lifestyles Unlimited member, he has been taught how to take advantage of something called a hard money loan. What's a hard money loan? A hard money loan is a loan that you take out that will loan you up to 70% of the after repair value on the property, up to 70%. So some of you are thinking, okay, so what was the after repair value on the property? Worked out to be $170,000. That was the appraisal price of the property in its finished condition. In other words, when it was all fixed up, the property is currently worth $170,000. So a hard money lender will lend you 70% of that after repair value. You use that money to buy the asset. By the way, he only paid $70,000 for the property. Pretty cool, huh? Even though the market research that I did indicated that back in the day when he was looking to buy it, the market kind of said, well, maybe it's worth about $98,000. He was able to get it for $70,000. Pretty cool, right? So he's got $100,000 of gross equity that he's working with. This is a game changer, and this is how he was able to do this deal for so little money out of pocket. We come back from the break, we'll break it on down.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next.
Need more unconventional wisdom that'll set you free? Subscribe to Lifestyles Unlimited on YouTube and binge content that will actually help you get where you want to go in life from people who are already there. With over 50,000 members and 32 years of proven success, there's so much more we want to share with you than what we have time for on the radio. On YouTube, we go beyond our shows and feature our best content from podcasts, interviews, expo, Masters Tour, fireside chats, special events, and more.
Creating the lifestyle you've always wanted. You're hearing Lifestyles Unlimited's Real Estate Investor Radio Show.
Welcome back to the second half of the Lifestyles Unlimited Real Estate Investor Radio Show. My name is Al Gordon, and as always, I'm working on your financial freedom. And I'm talking to you about a property that I had the opportunity to walk through over the weekend with a bunch of Lifestyles Unlimited members. One of our members was showcasing a property that he's basically at the 97% completion stage of this property. He's already put it on the market for rent, and he's just got a few more things that need to be done to really put the finishing touches on this property. And I will tell you, I am looking at interior pictures of this property, and I would swear that I'm in a property that commensurately would cost, I don't know, crazy amount of money to rent. What do I mean by crazy amount of money? Well, I've seen similar properties in this particular area that are renting for like upwards of $1,800, but the rent that our member is charging is only $1,250. Why is he only charging $1,250? It's because the rental comps in that particular area justify a $1,250 market rent for this particular size of property in its particular location. Now, just about a mile away, comparable properties are renting for upwards of $1,800. Now, why isn't he charging $1,800? Because the comps don't support it. The reason he's not charging the crazy amount of rent of $1,800 is because when renters go into the area and they look at what's available for rent, they compare apples to apples. They do. And if he were to attempt to rent this particular property for $1,800, it would sit on the market because renters would find different properties that are ranging from like $1,200 to $1,300, and they would rent those properties because it would make more economic sense to them than the $1,800 price point that you thought maybe he could rent the property for. So where did he learn all this stuff? Lifestyles Unlimited. That's where he learned all this stuff. And I'll tell you what, if you want to learn this stuff too, the easiest way to do it is to become a member of Lifestyles Unlimited. So you're probably wondering, okay, well, how do I do that? How do I become a member of Lifestyles Unlimited? Go to lifestylesunlimited.com, sign up for a free workshop. As soon as you get to lifestylesunlimited.com, it's going to give you the opportunity there's a button up there that says join free workshop. It doesn't mean that you're actually going to join a free workshop that is currently in progress. What it's going to do is going to give you an opportunity to register for an upcoming workshop. That way you can schedule it to the convenience of your time. And when you go through that workshop, what you will have found is that we have already given you the introductory roadmap that every Lifestyles Unlimited member follows. The same roadmap this member is following to achieve financial freedom. Now, I told you that we're going to get into the nuts and bolts of this particular property, but I think what I want to do right now is I just want to talk to you about the aesthetics of this property. I mean, this property was built in 1940. The properties around this property were mostly built in the 1940s. But there's a major exception to that. Well, this property is located in a part of San Antonio, Texas, which is gentrifying. What does that mean, gentrifying? It means it's going through a economic turnover where properties that were old and dilapidated are either being remodeled and brought to like new condition, kind of like this property that I'm telling you about, or new properties are being built in the area. Just a half a block from this particular property is a major Class A apartment community that is just absolutely gorgeous. And one of the neat things about that Class A property is that if people want to go rent in that apartment community, they're going to pay, now get this, they're going to pay more than $1,250 for an asset. And they're basically going to be an apartment building. Yeah, the apartment structures, the way they're built as 8-plexes. It's a big community of 8-plexes. So you're going to have people on either side of your walls. But this particular single-family house is on a corner lot. It has a now fenced-in yard. It is in great condition. And the neat thing about this property is that somebody could rent this property, get a slightly bigger interior product for actually less money than if they rented in the Class A property. Yeah, it's like a game changer, especially for a small family. I mean, you think about it. It's a 2-bedroom, 1-bath house. It's got a very modern kitchen. It's got tile flooring in the kitchen. It's got tile flooring in the bathroom area, and it's got vinyl plank flooring throughout the rest of the house. It is modern looking. I'm telling you, I'm looking at the pictures right now, and I would swear that this picture came right out of a brand new listing for a brand new apartment community, but it's not an apartment. It's a single family house. Yeah, with a fenced yard and its own driveway. It's a really neat property. And it's in an area that's gentrifying, meaning that there's a lot of money being invested in this area to turn old properties into like new properties, or they're building brand new assets in the neighborhood. And ironically, the brand new assets they're building, they cost way more than this particular property cost. So why don't we get into the financials of this property? This property, when it came out, when it was made available to Lifestyles Unlimited members, it was assessed by the realtor that presented it. His name's Greg, and he thought that the after repair value of the property was about $150,000. Now, I will tell you that the square footage of the property is only 700 square feet, and it's in its original condition, it was only a one-bedroom, one-bath house. So a lot of Lifestyles Unlimited members, they passed on this property because it didn't quite meet their acid test for what they were looking for. However, this member took notice of the property. This member realized that the location of this property was pristine. And one of the neat things about real estate is that when you take advantage of location, it's always in your favor. The other thing that he realized was that even though it had a massive one bedroom to it, that one bedroom could be cut into two bedrooms. You could still have a large master bedroom while still having a nice sized second bedroom for children. And that turned the property into a two bedroom, one bath asset. So now it's a more competitive asset in the marketplace because it meets the needs of your prospective renters. The other thing that he knew was that by modernizing the property, and he not only modernized the interior of the property, he modernized the exterior of the property too. He made this thing look just as good as the brand new assets that are being built in the neighborhood. Now get this. This asset, if it were brand new in the neighborhood, would cost probably in the neighborhood of around $300,000. Now remember, this property was built in 1940, so it's a slightly different asset, but he also knew that Greg might have been a little bit conservative on his after repair value. So when the two of them sat down and sharpened their pencil, they kind of realized that the after repair value in this property was probably closer to $170,000. And the neat thing about this property was it was available to be purchased for only $70,000. In other words, he's only buying this property for about 41% of the after repair value. It's 41 cents on the dollar that he's paying for the asset. And even though his repair costs to make this property beautiful again was close to $53,000, because he took advantage of a hard money loan, his actual cash out-of-pocket expenses were only $11,500. So when you take a look at the amount of money that he's putting into the property and what his costs are associated with the property, he's still only at about $133,000 in total all-in costs. That allows him to capture an additional $37,000 in equity. That's the difference between his all-in cost and the after repair value on this property. So when you take that $37,000 and you add it to the $11,500, he's starting out with, now get this, are you sitting down? Everybody should be sitting down, because when you take a look at that factor, he is at approximately $48,750 in total equity. And it only cost him $11,500 to buy all of that equity. That's one of the reasons we do what we do at Lifestyles Unlimited, because he is, well, I would say he's more than tripling his net worth just in this particular asset based on just this asset. Now, I'm not looking at his entire portfolio. I'm just looking at this particular asset. I mean, his return on capital gain, when you take into account that he's capturing over $37,000 in net equity, and it only cost him $11,500 to buy that additional equity, he's getting almost a 325% return just on the capital gains. It's huge. Now, the one thing about this property that I'm not a huge fan of, and I'll just be right up front and clear with you. The only thing that I'm not a huge fan of is that his cash flow on the property is only $136 per month. When you take into account what his mortgage costs are going to be and what the fair market rent of $1,250 on the property is, he's only making about $136 a month in cash flow. Now, some of you would say, whoa, wait a minute. Whoa, that's scary, because if he has one major repair, it's going to blow the bank. Well, he's not going to have to worry about making a major repair because he already made all the major repairs on the asset. Anything that could go wrong with this property has already been dealt with. So when somebody moves into this property, they're literally getting a brand new property, even though it's not brand new. It's like new, but it's not brand new because it was built in 1940, right? So, I mean, the water heater, replaced. Lighting, replaced. All the kitchen appliances, replaced. Anything that could go wrong in this property, replaced. Brand new air conditioning systems, brand new. Yeah, brand new. What can go wrong with brand new? Who cares? There's something called a warranty. So he's actually protected. So in this particular case, I mean, what I'm getting at is that normally I like to see at least $200 a month in cash flow. So for me, $136 per month doesn't meet my threshold. But when you consider the amount of equity that he's capturing in this property, it's a home run hit. Now, when you take a look at the 5 different ways we make money in real estate, which includes the fact that he's getting principal pay down, he's getting tax advantages, he's getting natural appreciation. In other words, the property is going to go up in value year over year because that's what real estate tends to do. Did you know that real estate tends to double in value every 20 years? Yeah, so if you use a 3.5% appreciation factor, you can get to that doubling effect. I looked at what he is poised to return if he held the property for 5 years. Now, are you sitting down again? Because if he held it for 5 years and then sold the property at the end of the 5 years, he would make almost 545% return on investment. And that does not include the $11,500 he put into the asset. Essentially, he would turn $11,500 into almost $66,000, netting an additional capital gain of $54,500. And that's all based on an $11,500 investment into this asset. This is why this is a home run hit. Now, I did ask him, I said, what are your plans for the property? And he said, well, what I'm concerned about is I want to capture that equity, and the best way for me to capture that equity is to sell the property. So he's planning to hold the property for about 2 years. So what would he make if he disposed of the asset after 2 years? It's still a 300% return on investment. He would make over $31,000 in addition to the $11,500 he put into the property, essentially netting almost $43,000 coming back to him after you consider all the costs of sale. Again, this is a home run property for this investor. And if you want to do what this investor is doing, if you want to do what I am doing, all you have to do is go to lifestylesunlimited.com, sign up for that free workshop, and let's get you going.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.